Hi, everybody. Welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm Larry Siegel, your host today, and our guest is Larry Speidell. He is the founder and chief investment officer of Frontier Global Partners, a firm that invests in frontier markets, which are the markets that are even more emerging than emerging markets. That he'll describe that, but they're the developing world. And Larry has been remarkably diverse in his interests and in his career. He started by observing the frontier markets from a periscope, which means he was a submarine officer in the Navy. Is that correct?
Yes.
And after that, he went into the investment business, first at Putnam uh, for a decade or so, then Battery March, the great the man who started quant investing in Boston in the 70s, and then later at Nicholas Applegate, and finally with an interlude at Art Laffer's firm, uh, finally setting up his own shop, Frontier. Why don't we start, as I usually do, with your origin story? I told a little, but it had no color, just some names. How did you come to be interested in frontier markets enough to set up a firm to invest in them? And what else in your life led to where you are now that you'd like to discuss?
Well, I really owe it all to Dean LeBaron at Battery March. We worked together in the quant business in the early days, and he approached me and said, "How would you like to go and give some lectures on finance in Dalian?" And I said, "Oh, of course, sure,
Where?
Dean, I'd love to." And I ran to my atlas to figure out where Dalian was. And it turns out Dalian is in Manchuria, in the eastern part of China that was once seized by the Russians. There was in Dalian a joint business school with the State University of New York and the Dalian Institute of Technology. And I gave a week of lectures, and I realized that they got it. I mean, they got the whole capital market idea. I talked to them about Lee Iacocca saving the Chrysler Corporation, which was hot news back then. And out of that, I came away with a great respect for China to begin with, but the prospect of development, which was happening in China with a vengeance back in the late 80s into the early 90s. And so the rest is history. I started working in emerging markets, worked in emerging markets at Nicholas Applegate, and then decided to go all the way into beyond emerging into the frontier. And here we
Larry,
are.
how would you define frontier markets, and give me a couple of examples of markets you're invested in?
Yeah, well, I think MSCI has done the work for us. They have a universe of about 20 markets that they don't think are sufficiently developed or sufficiently big. But among the markets, we've got Vietnam, which is one of my favorites. We have Bangladesh, which is probably the most diversifying market you could invest in. We've got markets in Eastern Europe like Romania and Slovenia that just fall through the cracks of emerging markets. And we have markets in Latin America, Colombia, Peru, and so forth. So it's a global universe. And one beauty of this universe is that the countries are not tied together. Each one goes its own way. So we can talk about that in terms of justifying my claim that frontier markets are low risk.
Well, that brings me to a good question. I hope it's a good question. Some of these countries, not all, are known for their political instability, and if the government is always at risk of falling and being replaced by a government with quite a different philosophy or agenda, uh, why are Why should investors be thinking about putting their money there?
To start with, on the political side, there's been a great convergence in the world with the instability of frontier and emerging countries being approached more closely by the instability of developed countries. So we've got obviously a crisis going on in France and Germany and Canada, and we've seen a lot of change happening in the US. So,
South Korea, the
you know,
United States, you name it. Yeah, right.
so I
Well, we're
guess I
going
think
through
I
a
want to.
rough patch, but in general, the developed world tends to stay in one place. And if we have a change of government in the United States, it's not, we're not getting a new republic like they do in France every couple decades. It's just a different administration.
And, the markets that we are invested in were historically founded by the International Finance Corporation, which is part of the World Bank.
Yeah.
And they instilled an equity culture, or at least tried to. I wish they would do more of that.
Uh, as a financial economist, I've repeated this mantra for probably 40 years. The developed world and the developing world have very different ratios of stock market capitalization to GDP. In simplified terms, the developing world produces an awful lot of the world's GDP, but doesn't have much market capitalization. And I think those two numbers should be getting closer and closer together, especially for frontier markets where they produce quite a lot in terms of the real economy. But market capitalization is kind of zero in a lot of places. Should these two numbers be getting closer together, and why aren't they getting closer faster?
The GDP of frontier is 6% of the world. The
Yeah.
market cap is 3. The US GDP is 25% of the world, and the market cap is 44. So as it happens, for frontier markets, market cap is half of the weighting of GDP. And for the US, the market cap is 176% of the weighting, while EFA is 81 and emerging is 74. So if you're thinking there should be a change afoot, it might be that the US market cap has gotten a little too big for its britches, and there
No,
would be
I agree.
convergence
Yeah.
from that direction.
But we don't really
Having,
want that.
well,
But it may happen, yes.
one of the great problems we have is that after John Templeton created the notion of international diversification, it stopped working about 15 years ago. And we're hoping it'll start working again. And money will flow and maybe trickle down theory into frontier eventually. But the problem of markets in general is that when they're poor, you can run a chart of GDP per capita relative to market cap as a percent of GDP. And there's a trend line that essentially, as countries get richer, the market cap as a percent of GDP goes up. So you have a double whammy.
Yes.
So as I was saying, frontier markets are growing faster than the rest. And as they grow faster than the rest, their market cap should rise. Fingers crossed.
The market cap relative to their GDP should rise, and the GDP should rise. So you get a double whammy. What is that, the double whammy that you were referring to?
Yep.
How's it working?
Slowly. Slowly. You have to go back over 200 years to really see the convergence of GDPs.
Well, I think
And
if you go back to 1945 or 48 is usually described as the year the Great Convergence began. It was the divergence started 200 years. I'm going to say 250 years ago. The United States was pretty prosperous, even in the 18th century. But basically, what we now call the developed world got developed and the rest of the world did not. And in 1948, China and India were as poor as they had been at the beginning of the 200 years, but we were on top of the world.
Well, I want to put in a plug for
And then you
Hans.
got the convergence. That's when you
Yeah,
wanted to
I
diversify.
want to put in a plug for Hans Rosling's book, Factfulness,
Yeah.
and his video, which you can Google, 200 years, 200 countries, 2 minutes. And his point is basically that if you go back 200 years, we were all poor. And he looks at life expectancy, and it was awful most of the world. But the challenge we have as investors is that we don't see things that move glacially. We check the morning news and see things that
Right.
happen tick by tick. So I guess I would say if you're a investor in the developing world, you need patience.
Well, I'm a patient investor, but I don't expect to live forever. What is the time horizon over which somebody would, for example, hold shares in a frontier market fund?
5 years, preferably 10. But it's much like if you think of the big fad today is to rush into private equity, which can't be liquid at all in the short term. And yet pension plans are making the move because all their liabilities are long term, and they say they don't care, except if the returns aren't there, then they care a lot, and they wish they were elsewhere, like in the Magnificent Seven.
Pension plans also have the curse of bad actuarial practices that are imposed on them. So if they are supposed to earn 8, I can't describe the pension actuary situation in any detail. If they're supposed to earn 8, they're also supposed to hold a portfolio of assets that have an average expected return of 8, which means that you take as much risk as possible. And that's
Yeah.
not a good thing because these things that go up at 8 can also go down 50.
Well, another factor is the short tenure of pension officers, let alone the short tenure of their boards. And all of that is predicated on last year's returns.
Right. Well, also with private equity having a long illiquid duration, you buy, and it's somebody else's problem to try to sell because you won't be in the same organization.
Exactly.
Yeah.
Exactly. It's the classic agent's risk.
Yeah. Well, unfortunately, principals have to turn over these decisions to agents, no matter what they do. So we're going to continue to have employers and employees. What would you suggest is a good allocation to Frontier? And how does that affect the, let's call it Markowitz efficiency of a portfolio?
Oh, this is a topic I love, big because if you believe that Harry Markowitz was right and that there is an efficient frontier, if you work it out for emerging markets versus frontier markets, you should have about 40% of your developing market exposure in the frontier. Now, this leads me to the question of risk and risk tolerance and how risky people want to be. And this is where I know, Larry, you have some thoughts about that slope of trade-off between risk and return. But when you get right down to it, Frontier being about 3% less volatility than emerging markets means that it wants to be in any combination of the two that you think of.
Well, I do think that Markowitz is right that there's an efficient frontier. The problem is getting the right inputs or forecasts. If you put in a big enough spread uh, of frontier expected returns over emerging, you'll get a big weight. If you put in a small enough spread, you'll get a lower weight. And I believe if you put in a negative spread, eventually the allocation of frontier goes away. How do you form a forecast for an optimizer that makes sense for frontier, and how does it compare with emerging?
Well, I'm glad you asked. I brought this, which is from a recent paper, and it's a frontier that is based upon 10 years of history. And you can work it out over other 10-year periods, but I used like 2014 to 2024. And Frontier had a couple of percent lower return than emerging. But because that shape of the curve, and I may be drawing this reverse,
Low
but you
correlation.
understand,
Yeah, I get it.
so you understand the way those things look, so like a banana. The fact is that you can begin with what was the recent relationship. And the recent relationship was 3% less standard deviation and a couple of percent less return. And on that basis, you get to what I was saying, the 40% or so. And you know, if you want to quibble, I'd say 20% would be fine too. But zero is not fine. I
Yeah,
think
no,
Frontier
zero is
helps.
not fine. You're missing the next China or Japan almost for certain. But you're also missing a bunch of countries that won't do well. But the one that does, or the two or three that do well, that's going to be your whole portfolio in 20 or 40 years.
Yeah, that's the analogy to private equity. A lot of those investments go belly up, but you know, in the frontier, by the time they get included in the universe, and that's not just the MSCI Frontier Index, but you know, the universe of countries with established stock markets, they rarely go away. You know, of course, in the emerging market universe, Russia went away. And, you know, that
Oh,
was
China
disappointing.
too.
Well, China certainly had its perilous plunge based on some random autocratic decisions. And Malaysia back 30 years ago, I guess, froze their stock market, and that wasn't a happy time. I think that all of the markets that are in the frontier um, have relatively low risk of blowing up their markets these days. Now, you know, it has happened in the past. And I guess I'd say I'm an optimist in response to that question. I think that if we fast forward 10 years, we'll be happy looking back on the path of developing markets in general and
I
Frontier in
agree. I
particular.
hope I'm around to see it.
Yeah,
On
me
that
too.
note, younger people will see many more wonders beyond 10 years. And on that note, and I'm absolutely sure of it. I would like to take a break. We're going to come back. I will reintroduce you, Larry, because some people will only be watching the second part, and we'll talk about some of the things that we discussed when we were preparing for this. The most heartwarming experiences you've had, maybe the scariest, and make this a little more casual and a little more personal. Thank you, Larry, for appearing on the Financial Thought Exchange, and we'll be right back.
For more information, please visit rpc.cfainstitute.org/research-foundation.